Hello, everybody. Welcome to Managerial Accounting. This is my another introduction video. This is talking about part one about the inventory for retailers versus the inventory for manufacturers. So one thing is that you'll hear me talk about this, and especially in these first few chapters for process costing, job order costing, as well as just determining cost of goods manufactured, is I use T accounts. And you're going to really want to do this, because if you have to memorize some kind of cost of goods manufactured statement, you're going to go absolutely bananas. But let's go through and see how we do this, right? So I've got assets equals liabilities plus owner's equity, ERDC, right? So assets typically have debit balances. They're increased with debits, decreased with credits. I record expenses with debits, revenues with credits. My liabilities and owner's equity accounts typically have credit balances. They're increased with credits and then decreased with debits. So when we sell inventory in financial accounting, so how does this generally work? Well, I'm going to go over here and I'm going to debit AR, credit sales revenue, debit cost of goods sold, and credit inventory, right? Cost of goods sold is an expense, right? So I'm going to record an expense with a debit. Inventory is an asset. When I sell inventory, my assets are going down. So I'm going to go over here and credit inventory. When I sell inventory on account, I'm going to debit accounts receivable because the customer still owes me the money, and I credit the revenues, right? So again, the T accounts are really important. Now, also too, when we're doing inventory for financial accounting, we're with a retailer, they're buying the inventory and reselling it, right? We've got beginning inventory plus purchases, gives me gas, right? And then over here, whatever I sell goes to cost of goods sold, crediting inventory, debiting cost of goods sold. Now for inventory for a manufacturer, let's go to the Google Sheets. Okay, everybody, this is exciting, right? So when we have inventory for a manufacturer, right, it's a little bit different. Why is it different? Because we're starting out over here with the raw materials, right? So these raw materials, once we put them into production, right, they're going to be coming over here from raw materials inventory. But raw materials inventory does not become finished goods inventory on its own. It needs a little love, a little patience. And so this is why over here, we're going to basically have that happen with over here with some factory payroll. And then we're going to be looking at some factory overhead. Oh boy, that happened twice. Okay, hold on. And then we have some factory overhead, right? Once it's in the work in process inventory, it's ultimately going to become over here, our finished goods inventory. This part over here of leaving work in process and going over to finished goods inventory is what we call our cost of goods manufactured, right? And this is something that we're going to want to do using T accounts, and I will show you why. Then over here for finished goods inventory to go to cost of goods sold, this is the last step. So this is where it looks like a traditional retailer. Remember, a traditional retailer will only have these two accounts, right? Because they're not manufacturing the product. But if we are a manufacturer, we have to go through this process. We're making the goods from scratch. So we're going to be using these different categories over here, or these different costs over here, to help this raw material inventory go to work in process. And then ultimately, it's going to become finished goods inventory. So that is kind of a little bit more of an overview. I want to thank you for watching today. If you have any questions, please feel free to leave them below. I appreciate your liking and subscribing. Liking the videos and subscribing to the channel. Thank you so much, and I'll see you on the next video. Have a great day.